Copyright University of Auckland, all rights reserved. The content and delivery of lectures in this course are protected by copyright. Material belonging to others may have been used in these lectures and copied by and solely for the educational purposes of the university under license. You may record the lectures for the purposes of private study or research, but you may not sell, alter, or further reproduce or distribute any part of these lectures to any other person. Failure to comply with the terms of this warning may expose you to legal action for copyright infringement by the copyright owner and/or disciplinary action by the university.
Okay, hello and welcome back. I'm assuming no one missed me while you're away, so I can say the same about you. But it is good to have you back. We've now got, how many more weeks have we got? 7? Something like that. Yeah, it's an odd break with the Easter and midterm break this year. So I'm going to actually extend the due date of the assignment. I didn't set it over the break because it really covers material that we will be covering shortly. And I wanted you to have time to focus on the next test that's coming up, which covered everything since the last test and through, I think, to this module. But it will be hopefully a wee bit easier to handle in that it's all multiple choice. You don't have to write anything. I had 1 or 2 complaints about having to write things online. Did anyone find that particularly onerous or difficult? Yeah. I won't do that again then. You'll have to write it out by hand. You can type it on and cut and paste into that. So we'll do it differently next time. Thank you for putting up with it though. Thank you for doing it. And I hope you feel happy with the marks you got so far. And if you're not happy, then a little bit of extra hard work will change that. We're moving on now to moving through life, if you like. We've got over short-term loans for things that keep you going through university and paying off your student loans. And now moving on to what's probably the next thing that's going to happen to you, starting to purchase fairly major assets. Or making the decision not to purchase major assets and simply carrying on renting and using the money that you have for other purposes. There's no judgment as to what's right or wrong here, but if you make a decision to purchase a fairly major asset, such as a house or land, then it invariably requires a lot of capital. And unless you're acquiring that capital from someone you know, most of us tend to end up having to borrow money in order to finance that purchase that we're making. And we may do this on a regular basis throughout our lives. Now, a little bit later on, I might make some comments about the selling and buying process, because I'm going through that at the moment. I'm selling a house and buying, I don't know what yet. We'll wait and see what happens with the sale process. So some of the comments will relate to what's actually happening in the market at the moment. The term that we're using to describe the finance associated with purchases are mortgage loans. Now, the mortgage is simply a description of the security interest that a lender takes over an asset, like a house, but we tend to link this to the loan to describe the type of secured loan that most of us will end up taking out to provide the capital for the purchase. So in order to go through this, I just wanted to make it clear the things that I wanted to ensure that you're able to focus on, both in terms of knowing a little bit about things and in terms of being able to answer questions. We'll look at major assets. It'll be everything from a nice new car, not a small old second-hand car, through to the really big assets like property, or moving through to investment properties rather than somewhere that you simply have to live. What considerations you need to take into account when you're making the decision, and then more technically the calculation of payments under different forms of loan structures. Needs. So we'll start with some of the fluffy stuff. What do you need to consider when you're buying a house? Is that the sound of air conditioning or of rain? I hope it's air conditioning, not ready for the rest. Okay, so our real estate market in New Zealand is quite diverse. I'll concentrate on residential properties. When we look at investments, we may elaborate a little bit into commercial properties and the types of tenants that may be available. But right at the moment, we'll simply consider residential real estate in New Zealand. If you're purchasing or selling real estate, most of the time you'll look to use a real estate agent. If you're a purchaser, please remember that a real estate agent, the word agent means somebody who works for somebody who's the principal in a relationship. And the person that a real estate agent is working for is the seller of the property. That's their job, that's what they're paid for, and that's their responsibility, is to look after the best interests of the seller of the property. So if you are looking to purchase, just remember that the ever so pleasant and helpful real estate agent is not working for you, they are working for the seller. And everything they tell you, legally, they're bound to do it in favour of the seller. That's their job. They're being paid by the seller, and so everything you hear from them will be the positives. The spin on everything will be positive in terms of what is being sold to you. So please be careful about that. Most sellers of real estate, although there are some companies now paying salaries rather than commissions to their real estate agents, work on a commission basis. That is, the agent who is helping the seller sell the property only receives any payment if the property gets sold. Commissions that are offered or asked for by real estate companies are always negotiable. No matter what a company tells you about its commissions, they are simply an agent who is asking for your business as a seller of a property, and the commission that they're willing to receive depends on their negotiation with you. Their starting point are their advertised commissions. The finishing point is whatever they're willing to work for you for. But as a buyer of property, you don't have to pay that commission directly yourself. It's part of the overall price that's expected by the seller in order to make them happy. They realise that a commission is going to be taken out and therefore normally won't accept a price that leaves them short of money at the end. In your buying process, though, you need to take account of the fact that in New Zealand, when you make a formal written offer to purchase a property, you're legally bound to continue with that. Once you sign the offer and acceptance agreement on a property, you need to be able to complete the transaction. Otherwise, you're at risk of having penalties imposed on you for failing to complete a contract that you've signed. Now, many of you may have come from other countries of the world where that is not quite the same as here, but our home ownership and buying process is very clear here. Once you sign a legal contract to purchase a property, you are bound by that contract until you complete on it. Normally associated with that contract is a surety that you will complete your side of the bargain, and that's referred to as a deposit that you have to pay when you agree to purchase the property. And that deposit generally in New Zealand is assumed to be around 10% of the purchase price of the property. And if you fail to complete your side of the transaction, that is, come up with the rest of the money and actually purchase the property, you may forfeit all or part of that deposit, it's not fully refundable, to compensate the seller for any losses that might be incurred through your failure to complete the transaction. Those losses could simply be the fee that's payable to the estate agent when the property is sold. Property is deemed to be sold when a signed sales and purchase agreement is evidenced. So that fee is immediately payable to the estate agent. And you as a buyer, if you fail to complete the transaction, that fee will be taken out of your deposit so that the seller isn't left short. So before you agree and sign any purchase agreement in New Zealand for real estate, make sure that you have access to all of the money that you need in order to complete the transaction. Once you have that, the settlement process becomes a legal process. That's not really part of our consideration in this. You have to make sure that you have the money. If you're borrowing that money from a lender, then you have to make sure that that lender is comfortable that the transaction will also proceed, and that when they pay the money, they will have the right to claim your house if anything should go wrong. So most of these transactions proceed through a lawyer who will ensure that the mortgage, that is the guarantee from the lender's point of view, that if something goes wrong, they have the right to take the house away from you. Once that document's been signed, your lawyer will then obtain the funds from your bank or whatever lender you're intending to use, pay it to the vendor, and arrange for all of the documentation to be finalised so that you become the owner of the property that you bought. So the important thing from our finance point of view is then ensuring that that financial side of things is in place so that you can make the acquisition that you want. Our general sources of finance for mortgages or for large loans for acquisition of large capital is through the normal channels that we've already looked at. Our banks, building societies and credit unions are the principal lenders in this area in New Zealand. When you see a mortgage broker offering you a loan, for instance, and probably our most famous one is our motorcycling friend Mike Pero, who doesn't actually lend you the money, he simply finds the company that bears his name, which he's no longer really associated with, finds a lender who's willing to lend you the money and organises the relationship between you and the lender in return for a fee. That fee is usually paid by the lender, not by you, the borrower. So most mortgage brokers are provided compensation by the lender in order to find you, the borrower, and undertake a lot of paperwork on the lender's behalf. So mortgage brokers do get paid. It's useful, or has historically been useful, for many banks and financial institutions to use mortgage brokers because it's kind of a low-cost alternative to employing people to analyse your loan request. If somebody else can do it and charge a relatively small fee for it, it's a lot cheaper for a lender than to employ lots and lots of full-time employees whose job it is to do that, and who may sometimes have nothing to do other than make tea and sit around and talk to each other. So we've historically had a lot of mortgage brokerage businesses grow up as a result of this cost assumption that's built in by most of our lenders. Now, what a mortgage broker is also going to try and do for you is not only source somebody who can provide a loan for you, but also find the type of loan that will suit your personal circumstances most appropriately at the time. And by that I mean we simply come to have a look at the term and the payment options associated with that loan to suit you as an individual. Now, a lot of that's going to be, again, dependent on your time of life. What type of property are you going to buy? Still, the most popular properties in New Zealand are single-family homes. Now, they do range from relatively modest and small apartment-style homes through to the very grand homes that you may have seen on some television programs, through to some extremely expensive homes. Very close to us is, how many people have heard of the rather large gentleman called Mr. Dotcom? Kim, I think, was his first name, wasn't it? He rented at one stage a property in Coatesville, which is not very far from where I live, which is a sprawling mansion on very large grounds with fake animals roaming the property. So there are giraffes and rhinoceroses, models of them stalking around this property, or looking like they're stalking around the property. It was suggested that his annual rental payments for the property were around $2 million a year. That's more than most of us would purchase a property for, let alone rent a property for. However, we're still talking about single-family homes there, even though there were accommodation provided for servants, or slaves, depending on how you want to look at them. This still is our most popular kind of property that's sold in New Zealand. If you want to go onto Trade Me and have a look at how many properties are sold throughout New Zealand, changes every day, of course, but you can have a look at the number of listings under real estate for residential property. Many, many tens or hundreds of thousands of property available for sale at any particular point in time. That's going backwards. Is that going backwards? Ownership of this type of property is really, really sought after because it's nice and contained and privacy. I don't know why I put privacy, but I suppose historically it's been said that a man's home is his castle. It provides a security around you that many other types of investments don't afford you, and provides you with a degree of control over that property that a lot of other things don't provide. The ownership of a property versus renting it allows you to do anything you like to that property, at least within the laws or local bylaws of the area in which that property is located. However, as you know from Auckland, certainly, the cost of an investment in this type of property has risen significantly and quickly over the past decade or two. People are saying at the moment things have flattened out. Simply means that the growth rate is not as high as it used to be. Property prices are, though, still growing, or so I've been told. There are benefits of owning rather than renting, not least of which is having some satisfaction of being able to evict people who you no longer want on your property. Your parents may have already done that to you. I'm certainly considering that for my children. A great deal of satisfaction in being able to do that. If you're a landlord, of course, if you've made an investment in a property and you have friends who are no longer friends and you don't want them in your property, you have the right to evict them from that property when it's yours. So there's a great deal of satisfaction. You can have tenants who become your tenants, who pay you money for the privilege of living in your house, a real benefit. Historically, the value of property has changed, and usually in an upward direction. And over long periods of time, the measurement of that increase in the value of the property has exceeded the general increase in other prices of things in New Zealand that we call inflation. So your ability to invest in this asset that grows in value and therefore gives you a rate of return when you sell it, generally provides you with a return that's significantly higher than the change in the cost of things to you. You tend to be ahead if you invest in property. But that very much depends on the timing. So what's available? Well, we have everything from apartments, and our definition of what an apartment is ranges from an ordinary, historically a flat, part of a block of units, through to townhouses or other buildings that are part of a major development. I live relatively close to a development that's known as, it's got a whole lot of different areas in it, but I suppose Hobsonville Point is the general description of the area, in which there's a range of separated houses, so individual houses, through to houses that are joined together, semi-detached, through to ones that are fully attached. They're houses in rows of houses. Some of them have multiple stories that we call townhouses. Anything above 2, I think, is referred to as a townhouse, but they all are the same type of thing. They're smaller and tend to be joined to other properties in major developments. Another feature of these is that the ownership of these is quite often an unusual combination of ownership. That is, it's a legal right of ownership of the particular property that you're purchasing, plus a shared interest in other parts of the surrounding land and properties. So it might simply be that the common hallways are shared and the living accommodation is your own. It might be that some outside garden areas are shared and the house itself is your own. These different ownership structures for different parts of it will all be covered in the ownership title that you have for that property. Each different type of ownership will be described fully on it, and your lawyer will be able to provide you with a relatively clear description of what it is that you're actually buying. If you do have ownership of one of these properties that has some kind of joint ownership, there is usually a maintenance charge to accompany it. So if you have an apartment that's built into a larger building, the larger building needs constant maintenance and care. And your ownership of a portion of it will be accompanied by an annual fee for the upkeep and maintenance of that building in general. However, in most cases, the total net cost of owning such a property generally is a little bit lower than owning a separate residential property that we would think of as a normal house or home in New Zealand. So, your problem in making this decision is what are you buying it for? Now, if it is for your own accommodation, or if it's for simply an investment that you're going to rent out to somebody else, one of the major concerns that you'll have is where do you buy it? We have programs on TV that are called location, 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 because it's so important to the value of the property where it's physically located. Now, it might be simply the city in which it's located or a part of that city in which it's located. Properties with views, particularly over the water, tend to be more expensive than properties without views. Properties close to public transport routes tend to be a little bit more expensive than those that are some distance from a public transport route. All things that you need to consider from your perspective, what's important to you to pay for when you're buying a property. Secondly, how big is it? It's like cars. We all like really big cars, don't we? It's the most popular vehicles in New Zealand. It's a truck, isn't it? It's those great big four-wheel drive double cab utes. 4 biggest selling vehicles in New Zealand are all utes. Who needs something that size? All they do is park out of parking spaces with their tow bars and make it difficult to drive past. How many people park in the OGGB building underneath it? You cannot drive past utes that have got tow bars, can you? Why do we need something so big? Well, properties tend to be sought after that are bigger because they're more prestigious, aren't they? Or, like me, because you've got 4 children that you need to fit into them. And then you need to downsize. So at the moment, from a personal perspective, size, suitable size is, for me, a 1-bedroom apartment. Because then children can't come back and live with you. No, I'm joking. Suitable for purpose is what's really important. If you're a growing family, if you intend to have more people moving in with you, the bigger the better. But size generally brings with it additional costs on a regular basis. So you need to take that into consideration. Similarly, size tends to also add to the value of a home. So holding all others constant, a larger home in the same area as a smaller home will generally be a little bit more expensive. And that then requires you to have a larger mortgage. And a larger mortgage typically means larger outgoings on a regular basis. Allied with that is what kind of mortgage you have. So now we're going to start to investigate this financial side of it. The size and kind of mortgage is going to dictate the regular payments that you have to make. And this comes down to our evaluation of costs. So let's break down the costs of owning a home into a variety of categories, some of which are time dependent and others dependent on the total value. So our first thing is a deposit. The deposit's payable before the transaction to purchase the property is finally completed. As soon as the paperwork is signed, you'll be required to make a deposit for the house and pay that to usually your lawyer to hold on behalf of the vendor. The deposit, as I said, is usually stated as being 10% of the value of the purchase price, but is negotiable down. It's meant to be there as a sign of good faith that you will conclude the transaction. A lot of people initially starting out purchasing a property don't have access to 10%. If the average property value in Auckland, does anyone know what the average property value in Auckland is? Yeah, some areas it's over $1 million. I don't think all areas in Auckland are over $1 million, but if we assume it's around about 600,000 or 700,000, that means you're going to have to find $60,000 or $70,000 in cash before you buy the property, just to guarantee that you will go ahead and buy it. Some vendors are willing to allow a negotiation down of that to 5%, but you're still going to have to front up with some cash before you even get hold of the property. Next are the other charges associated with being able to get hold of the money and then the property. Banks generally charge a fee for setting up your loan. Some of them will waive that fee if you've been a long-term good customer. Others will charge it regardless. And some banks' policies have recently changed to insist that they charge fees for all customers. Now, fees can range from a couple of $100 up to a couple of $1,000, simply for saying, yes, you can have the loan and here's some paperwork for you to sign to get it. In addition to that, there's the lawyers. Everyone loves lawyers, don't they? And lawyers will undertake the conveyancing or registering of your ownership for you. If you are selling a property, I believe it's still necessary to have a lawyer. If you're purchasing a property, you don't necessarily have to use a lawyer. Though I would suggest it's a good idea to have somebody who can look over things as a disinterested third party and offer you advice, obviously for a fee, that may save you a lot of headaches in the future. That cost of a lawyer often involves the physical cost of registering your ownership on the land. So our land registry office holds a record of every piece of land in New Zealand, a description of it and a record of who owns it. And simply the register of your name on that record costs money. Then we have the mortgage payments to organise, the actual loan repayment and interest payment transaction that takes place. Don't forget, on top of that, you've purchased a valuable asset, which if anything happens to it, you could lose a lot of money. And we have an entirely separate market that enables us to protect our interest in valuable assets by purchasing insurance. Insurance is quite important. It covers a lot of different things. It also doesn't cover many things in some areas. If a property is subject to flooding, or the area in which it's based is subject to flooding, often the insurance policy will exclude damage due to flooding. Similarly with earthquakes. We in New Zealand at least have part of our insurance covered by our government. Our earthquake insurance provides payment that's not from the insurance company for any damage caused by earthquakes. What else have you got to pay? Rates. Regardless of what services your local council provides, they will still charge you rates. Our council provides me with very little. I collect my own water. I dispose of my own wastewater. And I pay for a company to pick up my rubbish. And yet I still pay an awful lot of rates to my local council, supposedly for, I don't know what, providing me with these services that I pay other people for. Don't forget, a house costs money to maintain. Now, look, all we were going to do is think about these as additional costs that form part of your annual outgoings associated with your house. The real cost to you is a percentage cost, if you like, is going to have to be calculated from the dollar values of all of these extras that we often overlook and forget about. Maintenance expenses on properties can be very high. Simply to changing light bulbs. You know, LED light bulbs, there's ones that meant to last for 25,000 hours. They don't last for 25,000 hours, and they're quite expensive. little maintenance costs like that can be quite expensive. So let's go through each of these in turn, just so you've got an idea about how to analyse them. So the deposit, you pay for at the signing of the purchase agreement. It's part of your ownership. It will become part of it, but you've got to get it up front. It's also another thing to think about in terms of what you've got to put in. So I'd like to turn around the view of what the deposit is. You can't borrow, generally, the deposit that you pay for the house from your bank. Your bank thinks of this as what you're putting into it. You're putting at risk right at the start, but also you're putting at risk over the long term. And in most cases, our banks will lend only a percentage of the total value of the house. And in fact, of course, you probably know, our government required at one point that percentage to be relatively high. So for a first home purchase, at one stage, you had to front up with 20% of the value of the house from your own money, and your bank was only allowed to lend you 80%. But regardless of that relationship between your money and the bank's money, there is that relationship always there. Your bank wants you to put money in, a small amount, and it will put in a larger amount. And we talk about that as being the comparison of the loan value to the property value. That loan to value ratio, in most cases, banks will look to have as large as possible. It's their guarantee that if something goes wrong and they have to take your house and sell it, then they could sell a house for a reduced value and still get back all their loan. In some cases, your bank may even insist or ask you to purchase mortgage insurance, simply meaning that you buy an insurance policy which says if for any reason you're unable to earn money and pay the interest and principal on your loan, then this insurance policy will pay at least the interest on the loan for a predetermined period of time, usually around 2 years. Another guarantee for the bank that if something happens to you, it will continue to get its money. However, it's another cost to you of purchasing that insurance to protect somebody else in the event that something goes wrong. Just a summary then of these other costs. You've got your application fee. You've got to think of that as being part of the overall cost of your borrowing. There are all of these other things, as I said, that the lawyers do, and you'll get a fully detailed list from your lawyer. The cost is usually, depending on your lawyer, is usually around the sort of $300 to $500 mark. So it doesn't seem to be a great deal of money, but it's just another one of those lumps of money that you're going to have to come out with and pay out to people during this investment that you're making. It'll always be itemised and detailed in some detail from your lawyer, including a little list of the number of minutes that they've worked. And lawyers, like accountants, will generally charge out on a 6-minute basis. So every 6 minutes that they're doing work for you, they'll be multiplying that by their rate per 6 minute in order to calculate the cost of doing the work for you. You may or may not be aware that in New Zealand during the 1980s and 90s, there were a number of homes built using a construction method and materials that have left them susceptible to internal leaking during bad weather, and that the remedial cost of these houses is quite substantial. So another cost that you might have to consider, depending on the construction material of the property, is the fee to ensure you that this property is not what's referred to as a leaky home. So, let's get back to our arithmetic. Mortgage loans are similar to any other loan that we've looked at. They can have a variety of payment structures, but whatever it is that you do, you're going to end up paying principal, that is the amount that you borrowed, back on a regular basis, plus interest, that is the cost of borrowing that money charged by the bank, also on a regular basis. But it's the regularity, the frequency, and the balance between these two that will determine what your monthly outgoings are. So the first thing I'd like to look at is what we refer to as a principal and interest mortgage. And that's simply one where the amount of money that you pay on a regular basis is fixed. It's constant. So long as the interest rate remains constant, the amount you pay out on a regular basis will also remain constant. It'll be a mixture of principal and interest. The mixture will alter over time, but the amount that you pay in total will remain constant. So assuming we have constant interest rates that result in a constant stream of payments from you, what do we refer to that constant stream of equal payments on a regular basis, equally spaced in time? We had a word to describe it. It was called an annuity. And so our principal and interest mortgages use an arithmetic that we've already studied. It's the calculation of an amount that's payable using the annuity formula, with which I hope you're all familiar. We do have other types of mortgages that allow you to pay interest only, rather than principal and interest. So the annuity is pretty straightforward. It's the same arithmetic that we have used, and it's based around this. Well, it's probably easier for you to remember. It's based around that middle one there. The value of the loan determines the amount of cash flow simply by referring to one of two formulas. Our annuity formulas provide us with a method of calculating any of two variables, given that the other variables have already been pre-calculated. Our present value interest factor of the annuity relies on how long our loan is going for, that is, how many payments there are, and the interest rate that's being applied by the lender. We can pre-calculate that as our present value interest factor, and then based on our knowing the amount we're borrowing, we can calculate the cash flows. Or, as a borrower, we can work out in advance how much we can borrow by thinking about how much we can afford to pay on a regular basis. Our cash flow that we can afford can be put into this little formula to work out roughly how much we think we're capable of borrowing and maintaining the servicing for, therefore how much money we can borrow for our house. So while PV equals the cash flow times the interest factor, the cash flow equals the present value divided by the present value interest factor. So we've got two variables there, cash flow and present value. If you know one, you can calculate the other. If you want to know the other, you can calculate it using the one. Excuse me. So the sort of calculations that you will have a look at doing in your next test, for instance, or that you may want to work out for yourselves. If you take out a principal and interest mortgage of $100,000 to buy a cardboard box in the middle of the road somewhere in Auckland at that price, and it's a 30-year mortgage, and it's a 7% table basis, that is principal and interest, how much would it cost you? Now, I just make a note on here. If we're going to do this in reality, this will be a monthly payment that you have to make to your bank. So the total number of monthly payments will be 30 years times 12 payments per year, 360 payments. Your present value interest factor of an annuity table doesn't have a column or row that relates to 360 payments. So this type of question in this detail wouldn't appear in the exam. Our 7% per annum interest rate. Remember that if you see 7%, it's a rate that is referred to as the per annum rate each period of 1/12 of the year, has an interest rate applicable to it of 7 divided by 12. Plugging that into a formula or into a financial calculator, or finding a table on which there are sufficient blocks to locate this would give you an answer of a monthly payment what have we got there? I can't actually see it. So our, if you had tables, your present value interest factor on that table would be about 150, because your table just takes the formula and pre-calculates it. If we then want to work out what our monthly payments are, it's a monthly payment of $665. So can you afford $665 a month? If you can afford a $100,000 loan. When you take this out, your monthly payment is predominantly interest at the start. And you're gradually paying off small amounts of principal. Over the life of the loan, however, if you continue to pay that $665, the bank splits it up differently every time. As you pay off a little bit of your principal, so the next lot of interest will be smaller. And consequently, the proportion of that $665 that pays off the principal will be larger. It does, however, take you quite a long time to get rid of the interest and slowly get rid of the principal. So you can see that on a 30-year mortgage, it's well past 20 years before you've paid off half the mortgage. 2/3 of the way through the loan before you've paid half the mortgage off. Most of the early payments go to repaying the interest. Our total interest bill then is significantly more than the total amount of the loan. You borrow $100,000, you pay back the $100,000 plus $139,000, nearly $140,000 of interest. How do you reduce the amount of interest that you pay? Well, remember there are only 5 variables that we can deal with. How do you reduce the amount of interest you pay? Pay off the loan quicker. How do you pay off the loan quicker? Well, you're going to have to make bigger payments. The only way to reduce your loan more quickly is for you to make bigger payments or to make payments more frequently. You'll find a lot of banks offering you the ability to help you do this by saying, look, don't pay off your loan every month, pay it off more quickly. One way we can help you is to say, well, look, let's do the compound interest thing. If you paid off half the monthly payment every fortnight, you'd get rid of the loan a lot quicker. And because you're paying it off a little bit more quickly, the compound interest would be a little bit lower. So take your $665, cut it in half, $332, $333, and pay that amount every 2 weeks. Now, if you pay that amount every 2 weeks, how many payments are you making a year? 26. Because there's 52 weeks in a year. You're paying every 2 weeks, so that's 26 payments. 26 payments of half of 665 actually comes to 13 payments of 665. Not 12. So by splitting the amount you pay in half and paying it every fortnight, you don't think you're paying the extra, but you actually end up paying a whole lot more every year than you had originally started paying. By paying more every year and paying off the loan quicker, the total amount of interest you pay is going to be a lot smaller. That's something you can do to change the amount of interest you pay. What can your bank do for you? There's only one thing a bank can do to help you, and that's lower the interest rate. And our banks love doing that for us, don't they? So our little graph here is simply showing that, look, interest, even at relatively low rates, 7%, is a significant proportion of the money that you're paying. In 30 years, if you have paid $100,000 of principal and $139,000 of interest over that period of time, your property is going to have to have increased to at least $240,000 value for you to have covered the cost of owning that property, just the interest costs. 2.5 times increase in value. Well, we'd probably manage that in Auckland over 10 years instead of 30 years. Hence this statement a little bit earlier that property prices tend to increase at a rate far and above the interest cost associated with borrowing money to buy the house. I'm not encouraging you to go out and borrow money to buy property, but historically, property ownership has generally paid dividends for those who have entered into it. Now, some problems here. Sometimes interest rates in New Zealand have got very high. During the 1980s, interest rates on mortgages rose in New Zealand to close to 20% per annum. It's nearly a quarter of the value of your loan. Every year you're paying an interest. Relatively short period of time that occurred for, but still very damaging to the total cost you have on your mortgage compared to the value of the property. Right, what else? We haven't got anything else. You can do those calculations, but today we'll stop and we'll carry on with this tomorrow. Now look, your results for the test should be up. Everyone's seen them. You should also be able to see the correct answers or suggested solutions on Canvas. They're not showing? Then tomorrow morning you will be able to see it. I'll figure out why. Thank you.